Are you eager to purchase your very first home?
Yes, I am.
Have you heard about the First Home Savings Account?
Why do you think I'm here?
In today's video, I'll guide you through everything you need to know about the FHSA. So if you're seeking assistance in achieving your dream of home ownership, make sure you watch this video till the end. What exactly is a FHSA? It's a government-registered savings or investment account with tax advantages designed to help Canadians save for a down payment on their first home. To be eligible for the FHSA, you must be a Canadian resident aged between 18 and 71 and be a first-time homebuyer. As a first-time homebuyer, you should have not owned a home in the last 4 years, and the same applies to your spouse or common law partner. As the FHSA was recently introduced this year, it isn't widely available just yet. However, some institutions that offer this account include Questrade, Wealthsimple, RBC, National Bank, and EQ Bank. Many other institutions are also aiming to have this account available by the end of this year. Now, you may be wondering about the types of assets that you can hold in an FHSA. Eligible investments include cash, GICs, stocks, ETFs, bonds, and mutual funds. Assets available may vary depending on the FHSA provider. For instance, with EQ, you can only hold cash or GICs, while Wealthsimple allows you to hold stocks, options, and ETFs. Therefore, it's essential to choose an FHSA provider that aligns with your preferred assets. Given that saving for a house is often a short-term goal, it's generally not advisable to invest in riskier assets like stocks and ETFs. Instead, for those planning to buy a house in a few years, a safer approach would be to collect interest on cash or GICs. However, the best strategy ultimately depends on your timeline, risk tolerance, and how you plan to manage calculated risk. While the FHSA may not fully capitalize on compound interest and significant appreciation, its true strength lies in the tax benefits. The first benefit is that it's tax deductible, similar to an RRSP. Any contributions made to this account reduce your taxable income. So, for example, if your annual income is $100,000 and you contributed $8,000, your new taxable income would be $92,000. This tax deduction leads to an overpayment in taxes, resulting in a tax refund. In Ontario, using these numbers, you can expect a tax refund of approximately $2,700. You can use this refund for any purpose, but since you're saving for a house, it's wise to contribute it to your FHSA or another savings account dedicated to your down payment. The second tax benefit of the FHSA is tax-free withdrawals. Much like the TFSA, this means you can withdraw any amount from the account entirely tax-free, including your original deposit, interest accrued, capital gains, and dividends. To illustrate, if you contribute $8,000 into your FHSA and use it to purchase $8,000 worth of stocks, and that grows to $10,000, you won't owe any taxes at any point when you withdraw the funds, as long as you're using them to buy a home. In essence, the FHSA combines the best of both worlds: tax deductible when you deposit cash, and tax-free when you withdraw it. Let's dive into how contributions work. To claim contributions for a specific tax year, the deadline is December 31st of that year. You may also choose not to claim contributions in the year that you made them and save the tax deduction for a later year when you might have higher income to maximize your tax refund. The annual contribution limit is $8,000, which can be in the form of cash, securities, or even RRSPs. If you transfer from your RRSPs, there won't be any penalties or tax implications. However, you can't deduct this contribution from your income since you already claimed the deduction when you first contributed to the RRSP. Additionally, locked-in RRSPs cannot be transferred to the FHSA. Overall, the total contribution room available is $40,000. Hence, contributing $8,000 per year would take 5 years to max out your FHSA. Any unused contribution room can carry over 1 year. You cannot accumulate more than $16,000 of contribution room at any given time. To check your available contribution room, log into your CRA account and review your notice of assessment. Note that having multiple FHSAs won't affect your contribution room, and any interest, capital gains, or dividend payments also won't influence it. The thing is, multiple FHSAs will make your contribution room harder to track. This may cause you to overcontribute. Be aware that there is a 1% penalty for every month on the overcontribution till you correct the issue.
Put it back! Put it back!
Now let's take a look at withdrawing from your FHSA. there are two situations where you must withdraw from your account: the 15th year after you first opened your account, or the year you turn 71, whatever comes first. There's three options for withdrawing. One, to make a qualifying withdrawal, meaning to buy your first home and live in it as your principal place of residence. If you do make a qualifying withdrawal, you must close the account the following year and you won't be able to open up another one. Two, not withdrawing but transferring to your RRSPs. Doing this won't trigger any tax implications and your RRSP room won't be affected. And three, withdrawing the amount to do whatever you want with it. However, if you withdraw from the FHSA not to purchase a home, this amount will be added to your taxable income and you'll be taxed on the full amount, which will be whatever your marginal tax rate is. Now, if you're wondering about ways to increase your down payment contributions, you can do so by combining the FHSA with the home buyer's plan. The home buyer's plan allows you to use up to $35,000 of your RRSPs to purchase a home, but you need to repay that amount back into your RRSPs within 15 years. When choosing between the two accounts, it depends on several factors, but in general, the FHSA is more appealing because you don't have to repay it and the funds go directly towards your goal of home ownership. On the other hand, contributing to your RRSPs solely to use the home buyer's plan requires repayment, and eventually you'll need to withdraw from your RRSPs and pay taxes on it. And RRSPs may not be suitable for everyone depending on your personal circumstances. Another way to increase your down payment is with your spouse or common law partner. They may also open their own FHSA and use it for the same home purchase. Just be aware you cannot directly contribute to your spouse's FHSA. You can gift them the money, but they will receive the tax benefits. In conclusion, the FHSA is an excellent choice for any first-time home buyer aiming to purchase a home. While there are maximum contribution limits, you can also consider combining the FHSA with registered or non-registered accounts to reach your desired down payment. If you're interested in learning more about these alternative accounts, feel free to check out the videos on the right of the screen. Thanks for watching. Until next time, keep making money moves. Peace!